is Brett Mooney, and welcome back to Mooney Talks Money. Today, I'm going to focus on the opportunity in bond markets and dive into the math in terms of why it makes sense to own bonds in the current economic environment that we're in. In order to have a true understanding of the potential return in bonds, you have to really understand two major differences in how you can calculate the return you can get in a bond. And there's two ways to do that. And the first way is just by understanding the coupon of the bond, right? So just to understand the coupon, that's the specified amount of interest or coupon payment that the issuer offers, right? So that one's not as hard to understand. Typically, when you go to purchase a bond, that's in the title of the bond. It'll tell you exactly the amount of interest that it's going to pay you on an annual basis for the lifetime of that bond. But what becomes a little bit harder to understand is the yield to maturity of a bond. And that's the true return you would get in that bond if you hold it for the length of its maturity, right? Whether it's a 10-year bond or a 5-year bond, right? We're not just looking at the coupon that it pays annually. We're looking at the return you can get in the bond over the lifetime of the issue. And what I want to focus on here is how you can kind of determine whether or not the yield to maturity is higher or lower than the current coupon of the bond. You have to understand that bonds have a par value. And depending on the size of the bond, the par value is either going to be $100 per bond or $1,000 per bond, right? And the yield to maturity fluctuates depending on what that price of the bond is throughout the term, right? So typically when fluctuating interest rate environments like last year, bond prices took a hit, right? So many bonds are actually trading at a discount right now or less than their par value, whether it's $100 or $1,000. So what I want to kind of focus on is, or what I want to make sure you guys have an understanding on is when is it more advantageous to own a bond, right? When is that yield to maturity higher than its stated coupon, right? Well, the yield to maturity is higher than its stated coupon if the bond is trading at less than its par value, or in other words, at a discount, right? Or on the other side of things, right, you're going to get a worse or less return than the stated coupon if the bond's trading at a premium, right? So in other words, if a bond's trading at a discount, it's more advantageous for the investor. If a bond's trading at a premium, it's most likely less advantageous for an investor. So that's kind of the first thing to understand is the par value of a bond, right? So that doesn't necessarily fluctuate at the end of the term, but that's going to fluctuate throughout the term of the bond. But as long as that company doesn't default, right, we know that at the end of the term, it's going to trade back at par value. So what I want to kind of give you guys an understanding on is how to calculate that yield to maturity, right? Because there's a lot of bonds out there right now that are trading at discounts given last year's economic conditions, right? We raised interest rates quite a bit. So prices of bonds took a little bit of a hit last year, and there might be an opportunity to enter those assets right now. So I want to give you guys an idea on how to calculate yield to maturity. So just to give you an idea, right, yield to maturity is the stated coupon plus the par value minus its current price over the current number of years, right? So just to give you an example of that, right, you might purchase a 5-year bond, right, that pays a 6% annual coupon, right? So you know, hey, I'm going to get a 6% coupon annually on whatever dollar amount I put in this bond, right? But what's harder to calculate is if you hold that bond to maturity, right, what's your total return over the lifetime of that bond? Right? So if you enter into a bond at a discount, you get that 6% yield, but you also are going to get the price appreciation from that bond price from where it's at to par value upon its maturity. So for example, if you purchased a bond that was trading at a, say, 10% discount or $90 of its $100 par, not only do you get the 6% rate of return on the coupon, right, but over that 5-year term, you're going to get a 10% price appreciation over that 5-year period, right? So 10% over 5 years is 2% return on average per year, plus the 6% coupon that you get. So your yield to maturity would be closer to about 8%, even though its stated coupon was only 6%. Right. So due to last year's interest rate environments, right, there's a lot of bonds that are trading at discounts, as I mentioned earlier, right? So there's opportunities to get a higher yield, right, than the coupon that's stated on the current bonds, at least right now. There's also an expectation that interest rates actually start to come down over the next 12 to 18 months. And if that happens, right, there's a likelihood that those bonds get closer to par value quicker, right, prior to maturity, right? Because as interest rates go down, bond prices go back or go up and get closer to par value again. So there's a pretty good opportunity from a math perspective in bonds, and there might be an even more of an advantageous or an opportunity in bonds, given that the expectation for interest rates could come down, and you might be able to see that appreciation a little bit quicker than you normally would. So that's what we had today in terms of Mooney Talks Money. We wanted to give you guys a kind of an in-depth breakdown into the math behind why bonds make sense right now. If you're interested in looking at the types of bonds that are out there, right, it could depend on your tax situation. There are more tax efficient bonds than others, right? There's more aggressive bonds that pay higher yields. There's more conservative bonds, right? So there's a lot of different avenues that you could utilize bonds and take advantage of the math-based return that you can get in those types of asset classes right now. So feel free to reach out or leave a comment below with future topics, or if you guys have any particular questions and want to touch base, feel free to reach out to us. Thanks, and enjoy the rest of your guys' day.